Hello, guys. Can you start now? Can everyone hear me? So if you can hear me, raise your hand. Okay, so let me join. So give me 5 more minutes so that I can sort out something to do with the app, and then we can start.
Hi, everyone. On today's training, we are going to go through portfolio management. In the meantime, if you have any questions concerning the topic of the day, you can leave them in the chat section, and we will be happy to address them in the course of this training. In the meantime, maybe we can start by stating where we are joining the training from. Yes. Would you like to share with us where you're joining us today? And we'll be happy to learn where our investors or new investors are joining us from today.
Perfect. I think we're good now. So let me start by introducing portfolio management. Let me first confirm. Can everyone hear me? If you can hear me, raise your hand. Perfect. So just as I had mentioned, the first 30 minutes, we're going to go through the PDF just to make everything clear. And then the last 30 minutes, we're going to do a practical with the app. So that's what I was sorting out. So I'll need to show you the app, basically how to manage your portfolio on the app, basically how to select some stocks on the app, etc, etc. So I think one of you requested that last time, yeah? Hi. So let's start. So let's start by defining portfolio management. And basically, portfolio management can be defined as the process of managing individuals' investments so that you can maximize earnings and then at the same time reduce your risk. So the entire process is meant to maximize your earnings and reduce your risks. So primarily, portfolio manager serves as a SWOT, that's analysis. That's looking at the strengths, the weaknesses, the opportunities, and the threats of different investment avenues with the investor's goals against your risk appetite. Okay, so that's the basic definition of portfolio management. So it's time to look at the objectives of portfolio management. Why are you doing portfolio management, or why is it important for an investor to do portfolio management? Okay, so some of the core objectives of portfolio management are capital appreciation, maximizing returns on investment, and then basically improving the proficiency of the portfolio, risk optimization, which is really important. I think I'm going to talk a lot about that, risk optimization, and then allocating resources optimally, and then ensuring flexibility of the portfolio, especially going with the market conditions, and then protecting earnings against market risk. So those are the objectives. So don't worry, guys. I'm going through it quite fast because we'll have a practical session. So don't worry about it. So the two types of portfolio management, and broadly mentioning the two types, we have active portfolio management, and then we have passive portfolio management. And for, I don't know what you guys like. Most guys are like, I want passive portfolio management because I don't get to work a lot. I don't have time to look at the markets. But anyway, both types of managements are good. So when you talk about active portfolio management, these are types of management where the investor is mostly concerned with generating maximum returns. So active management will involve an attempt to beat the performance of an index, let's say the S&P 500 index or the NASDAQ 100 index, by actively buying and selling individual stocks and other assets. So for an active investor, this is the person who is going to spend quite some time trading and looking at the markets. His or her goal will be to purchase these stocks when they're undervalued and sell them when their value increases. On the other hand, for a passive, there's a huge difference between an active portfolio manager and a passive portfolio manager. These two investors are doing two different things. So for a passive portfolio manager, he or she is concerned with a fixed profile that aligns perfectly with the current market trends. So such investors are more likely to invest in exchange traded index funds with low but steady returns, which may seem profitable in the long run. This is commonly referred to as indexing or index investing. Basically, this is a set it and forget it long-term strategy. And when we talk about passive portfolio management and active portfolio management, one of the things that will determine how we go about it is, I always tell beginners or the guys who are starting out, you're better off starting with index ETFs. As you start, because when starting, you don't know which companies are good for you. You don't know, I need to select this company. I need to research on this specific company. Why is this company good compared to this other company? So it's important, especially when you're starting out, if you don't know anything about the markets, just start with the index funds. And we have various index funds. So we have, let's say, a good index fund is the VOO, the Vanguard 500 ETF. So the Vanguard tracks the S&P 500 ETF. When you're investing in this ETF, you're basically investing in the 500 largest companies in the US. So the Vanguard 500 ETF would be for someone who wants to be as passive as you can be in the markets. Okay. On the other hand, if you want to get some activity or you want some growth, you'd go for let's say the triple Q ETFs. These are ETFs that track the Nasdaq 100 ETF. So the Nasdaq 100 index. The Nasdaq 100 index tends to be more volatile compared to the S&P 500 index. By the same time, you're still doing passive. You're just investing in an index. So the Nasdaq index has had an average return of, I think, 17% annually. On the other hand, the S&P 500 index has had an average returns of around 10% annually. So for a person who is investing in the S&P 500 index, you're basically investing in 500 of the largest companies in the US. And then for a person who is investing in the Nasdaq 100, you're investing in some of the most valuable companies in the US, 100 of the most valuable companies in the US, with a huge composition of mostly tech companies in the tech sector. I think over 50% companies are in the tech sector. So that's on passive portfolio management. Then let's look at the key elements of portfolio management. And this is where I want us to spend quite some time. So several strategies must be implemented to ensure sound investment portfolio management so that investors can boost their earnings and lower risk significantly. So what are the key elements of portfolio management? You might want to write this. So we have asset allocation, we have diversification, and we have rebalancing. So these are the key elements of portfolio management: asset allocation, diversification, and rebalancing. So essentially, well, let's start with asset allocation. So asset allocation is essentially the process where investors put money in both volatile and non-volatile assets in such a way that helps generate substantial returns at minimal risk. So the best way to do it is your asset allocation must be aligned as per your financial goals and your risk appetite. So the key to effective portfolio management in the long term is a mix of assets. So generally that means having stocks, bonds, ETFs, rates, cryptocurrencies, and commodities in your portfolios. So I think by now you guys see why we're doing this as a series. So I think for now we've done 2 webinars so far in this series of investment. The first webinar was on investment strategies, and then last week we talked about how to select good investments. And one thing you might have noticed in all the webinars we've done so far, I've always emphasized on having a goal, and the goal is determined by several key factors such as risk appetite. Okay, so this will be important because this will determine your investment approach. So for investors with a more aggressive approach, these are investors who are willing to incur or rather face a lot of risk, but also have the potential of higher returns. We go for an aggressive approach. And so for investors with a more aggressive approach, the weight of their portfolio will be more towards volatile investments such as growth stocks. A good example is the tech stocks. We can talk about tech stocks. We can talk about, let's say, artificial intelligence stocks. We can talk about cloud computing stocks. We can talk about cryptocurrency ETFs, right? On the other hand, investors with a conservative approach will weight their portfolio towards stable investments such as bonds and blue chip stocks. So it's important to determine your risk profile as we mentioned last time. So I'll show you guys practical asset allocation when we're doing the practical. So let's talk about diversification. I think I've really emphasized a lot on diversification in the past 2 webinars. So diversification ensures that an investor's portfolio is well balanced and diversified across different investment avenues. So the reason why you're diversifying is so that you can achieve a perfect blend of risk and reward. So when you're talking about diversification, the various ways to diversify your portfolio, I think we have done a few webinars on this, on diversification. And the easiest way to diversify your portfolio is to invest in ETFs. ETFs basically are a basket of securities. And when you invest in ETFs, it makes it easier to diversify without having to select individual stocks. So let's say you're investing in an ETF, like the basics of all, the Vanguard 500 ETF. You have 500 stocks in your portfolio across different sectors in the market. I think this is as easy as it gets when we're talking about diversification. Also, at the same time, diversification doesn't mean only investing in ETFs. You can also have different asset classes. So you can also have some rates, have some ETFs, have some stocks, have some commodities, that's like gold and oil. I think the guys in our WhatsApp group have been sending some oil stocks you can invest in, some gold stocks you can invest in. At the same time, when you're talking about diversification, you also need to know about the sectors. We have 11 sectors in the US stock market. So you need to diversify across the various sectors. You need to have some stocks in, let's say, the utility sector, have some stocks in the financial sector, have some stocks in the energy sector, have some stocks in the information technology sector. So it's important to just have an understanding of the various sectors. And if you want to go further, have an understanding of how various sectors perform in various market conditions. So I think I'm going to cover a little bit about that when talking about the next point, which is rebalancing. Okay, let's talk about rebalancing. So rebalancing is basically the main reason why you need to rebalance is because you need to return your portfolio to its original target allocation. Going back to the first point about goals, rather the first point, or rather our focus on the first webinar in this series, investment strategies. We talked about using your goals and your risk appetite to come up with a good portfolio, yeah? And there's a way you have structured your portfolio. So you want to consistently rebalance your portfolio, basically to make sure that your portfolio goes back to its original target allocation, basically after maybe the markets have disrupted their original composition. And you'll see how this happens. So let me give you an example. Let's say a portfolio started with 70%. So let's say a portfolio started with a 70% equity and 30% fixed income allocation. After, let's say, an extended market rally, the portfolio shifts to an 80-20 allocation. So the investor has made a good profit, but the portfolio now has more risk than the investor can tolerate. So it's time to rebalance that portfolio. Putting it simply, one simple definition of rebalancing is basically rebalancing generally involves selling high-priced assets and putting that money to work in lower-priced assets. Okay? So the annual exercise of rebalancing allows the investor to capture gains and expand the opportunity for growth in high potential sector while keeping the portfolio aligned with the original risk or return profile. So when talking about rebalancing, let me give a practical example. let's say you have holdings of, let's say you have some tech stocks, and then you have some more conservative stocks such as utility stocks, right? And then you bought at the beginning of the year. So having bought at the beginning of the year, let's say you bought some stocks like Nvidia, you bought some stocks like Meta, right? You have Meta, you have Nvidia in your portfolio, and you have some utility stocks. Okay, so what you do right now, Meta has gained over 100%, and Nvidia has gained over 80% year to date. So to rebalance your portfolio, you'd want to say, yes, I've gotten a return of over 100% with Meta, that's Facebook, and I've gotten a return of over, let's say, 80% with Nvidia. It's time to reduce my holdings, or rather my exposure in the tech sector, and go for a more and look for other stocks that are likely to gain, considering what's happening in the markets right now. I think I'll talk about that in the practical example I'm going to give you. So you're reducing your holdings in companies that have already given you a significant returns, or companies that have already gained a lot. So, and that's why we have the set take profit and set stop loss on our app. So I think that's why it's important, as we mentioned in the earlier webinars, to set a goal. You need to have a goal of what amount of returns am I looking for in this specific stock. And this will mostly, I'm talking mostly to the active investors, the guys who want, let me just say the young people, the guys who want to be active in the market. So you're like, I'm buying this stock and I'm looking for, let's say, at least a 60% or 100% return on investment on this specific stock. So the moment you get that, it's important you should not have greed in the markets. You just say, I've gotten my returns on this stock. It's time to reduce my holdings and look for other stocks that are likely to give me a more that have more upside potential, right? So basically, you're looking for stocks you think are undervalued, right? I think this is what someone who, let me give a practical example of the beginning of this year, that's 2023. Last year, energy stocks were doing very well. Like energy, actually, the best performing company last year was an energy stock called Occidental Petroleum. I think it gained around 114% year to date in 2023. I mean, annual returns in 2023. So, let's say we are entering a new year, that's 2023. You had some energy stocks in your portfolio. The energy stocks have given you over 100% returns in the year, that's last year. And then you're looking in the markets, you're like, okay, this is quite interesting. Facebook has fallen. Facebook has fallen over 60%. Tesla has fallen over, I think, over 60% at the same time. There was a time, I think, at the beginning of the year, Tesla was almost going to 100 USD. So you're like, okay, this is interesting, but I've already gotten some returns from my energy stock. I think it's time to, when you're doing your annual rebalancing, this is what you do. You'll be like, okay, so I think that's it for the energy stocks. I've already gotten some returns for the energy stock, but it's time to look at these stocks, the Teslas, the Facebooks at the beginning of the year. So these stocks are quite, personally, I believe these stocks are quite undervalued. This is what will be going through your mind at the beginning of the year. So Tesla is a good company. Let's say Facebook is a good company. These companies are down over 60%. So I'm like, okay, it's time to reduce my holdings in energy stocks and increase my holdings in these tech stocks. Okay, so that's an example of how you'd approach rebalancing your portfolio. Okay, let's look at another practical example of rebalancing your portfolio. So for the guys who have been following the news, yesterday the Federal Reserve hiked interest rates with the 25 basis points. And the thing about interest rates is the Federal Reserve uses interest rates to control basically the economic situation in the US. That's the US Federal Reserve, in short, the Fed. So we have two types of activities, or rather approaches that the Fed uses to control inflation. That's aggressive monetary policy and a more conservative monetary policy. So for, let's say, when for the longest time, I think, especially for the longest time since 2022, they've been hiking rates aggressively. We came from 75 basis points to 50 basis points, and now at 25 basis points. And yesterday, when they hiked interest rates, they said that this would be the signal that this would be the last hike, and now we're going to get a pause in interest rates. And there's a webinar I did quite some time, I think last year, where I talked about factors that affect the stock market. And one of the major factors that affect the stock market would be interest rates. Actually, there's a saying in the stock market. I don't know if I can phrase it right. I cannot predict where stocks would be in the next 20 years, but just tell me where interest rates will be. That would work. Just tell me where the interest rates would be. So that just goes to show you how important interest rates are to the performance of the stock market. So, okay, so this is the point on market conditions, balancing your portfolio to the current market conditions. So we're coming from an environment where we have been having aggressive hikes of interest rates. Now we're getting a pause. We're going to an environment where we're going to have lower interest rates. So one thing to note is that lower interest rates affect market sectors differently. So the sectors that perform well in an environment where we have aggressive rates, and then the sectors that perform well in an environment where we have low interest rates. So let's talk about that. So let's say right now you have a portfolio with various stocks in various sectors. In the 11 sectors that you have stocks, you have bonds, etc, etc. How would you balance, or rather, how would you rebalance your portfolio to adapt to the current market conditions right now? A condition where we're seeing a Fed pivot from aggressive monetary policy to an environment where we're going to have lower interest rates. Let's talk about that. So in such a situation, the investor will reduce his holdings of assets that perform well in a high interest rate market environment, such as bonds, and increase his or her holdings in assets that perform well in a low interest rate market environment, such as utility stocks. So let's have a look at some of these sectors. So one sector that performs well in such an environment is the consumer discretionary sector. And the consumer discretionary sector is basically, these will be companies that sell stuff that you don't need, but you want to buy. Basically, these are cars, luxury brands. Yeah. So historically, this sector has historically performed well in a low rate environment. This is because consumer can now borrow money at low interest rates to fund these purchases, because at the same time, the companies will now have strong balance sheets. And let me give you some examples of consumer discretionary stocks. We have, let's say, Amazon, Tesla, Nike, and McDonald's. On the other hand, another sector that performs well in low interest rates is the information technology sector, basically the tech stocks. And one of the sectors that is heavily affected by interest rates is the tech sector. I think that's one of the reasons why this sector performed really bad last year. It was actually one of the worst performing sector. You saw companies like Facebook, or even companies like Facebook, losing almost 60% of their share price. Okay, so the tech sector can be very sensitive to high interest rates. So in general, low interest rates would help tech companies decrease operating costs and possibly achieve profitability faster. At the same time, it would make borrowing cash for research and product development cheaper and more accessible. Yeah. So the tech sector is another sector that is likely to perform well during such market conditions, low interest rate environment. So examples of companies in the information and technology sector would be Apple, Microsoft, and Nvidia. And just to mention, Apple is going to report earnings today after market close. That's around 11 p.m. today at night, East African time. So watch out for that. Finally, another sector that performs well during low interest rate market conditions would be the utilities sector. So utilities, these are basically companies that, let's say, generate electricity, provide water, basically the utilities. So utility stocks become more attractive when rates are low because the dividend yields begin to look more favorable compared to bonds. I think by now you guys can remember we mentioned that bonds tend to perform well when interest rates are high. And this is one of the reasons why the Kenyan market was performing really badly last year, because when the US is raising interest rates, and note that majority, over 70% of activity in our market is from foreign investors. So investors will be like, okay, I'm investing in the Kenyan market, that's the emerging markets, and the risk is high. Why don't I go to the US and invest in US bonds where the rates are now quite favorable? So we saw an exit of investors from emerging markets like Kenya and going to the US because bonds were doing well because of the aggressive rate hikes from the Fed. So on to this point, sorry, I veered off a bit. So bonds and utility stocks compete with each other because they both attract conservative investors. Going back to my first point on aggressive and conservative approaches. So these investors want a stable investment that has a fairly high yield, whether it's a bond yield or a stock dividend. So when rates are low, conservative investors gravitate towards utility stocks because low interest rates make bond yields low. Okay, so examples of utility stocks would be Duke Energy and PG&E Corporation. So finally, as we conclude, before we go to the practical session, common portfolio management strategies, we have the aggressive strategy, we have the conservative strategy, we have the moderate strategy, and we have the income-oriented strategy. So I think conservative and aggressive and moderate, I've already talked about that. Income-oriented strategy, this for older investors. As you grow old, maybe you've already made your money. Now it's time to focus on income. Basically, you want something that will give you consistent income. You'd want to rebalance your portfolio, reduce stocks that don't pay dividends, and now go for stocks that have consistently increased their dividends. So in such a situation, you'd go for what we call dividend aristocrats, right? In such a situation. So you'll go for dividend aristocrats. You'd also go for some US rates. There's some US rates that pay dividends monthly. You'd also go for some US stocks that pay US ETFs that pay dividends monthly, such as the JP, the one I sent on our WhatsApp group. So you'd want to reduce more of your holdings that don't pay you dividends and increase holdings in companies that pay you consistent dividends. So that's the thing about income-oriented portfolio management. So that's it on the theory part. I think it's time to go to the practical part. Before I go to the practical part, let me get some questions from you guys. You can type your questions on the chat section and then I'll be able to answer your question. So I'm
getting some feedback soon, so let me mute mic.
So if you guys can hear me, please raise your hand. Perfect. So let's go through rebalancing our portfolio practically. Okay, so let's start. We're looking at a situation where, so this is where you click to see your holdings. So let's look at some of the US stocks. Okay, so let's say we have a situation where we have the interest rates are being reduced by the Federal Reserve. And I've told you there are three sectors that tend to perform well during such a situation. So where will you start? You'd come to US stocks under all stocks. So you can see the various categories. I think even let me not even start there. Let me start by investment strategies. Basically, this is someone who is the first step where you're looking to allocate between various categories. So you can see the categories available. So you've just clicked on US stocks. So we have the all stocks. This is where you click to get access to all the stocks available. Okay. So you'll see the all stocks. You can just type a random name, let's say Tesla, and you'll be able to see the specific stock. Okay. So let's say you are an aggressive investor, and I've told you guys an aggressive investor will go for the growth stocks. So you just come on our app. You don't need to even just have a lot of stress about thinking about where should I find growth stocks, where should I find value stocks. So if you want to adopt an aggressive strategy in your portfolio, you'll go to categories and then go to growth stocks. When you go to growth stocks, you'll be able to see some of the growth stocks that you can be able to buy on our app. So we have examples of Tesla, Shopify, Block, Netflix, Amazon, and Alphabet. So when you see such stocks, please remember we also talked about diversification. So I don't want you guys to come here and buy all these stocks. You just select a few. So you can select, let's say Tesla, then buy. You just click on buy, then come maybe select Google and buy. Okay. On the other hand, let's say you're a more conservative investor, so you'll go for the blue chip stocks, right? These are some of the biggest companies in the US that have so more stable. These are more stable companies basically. So you'll not go for the growth stocks, you'll go for the blue chip stocks. So click on blue chip stocks. You'll be able to see some of the blue chip companies in the apps, something like the Bank of America, Caterpillar, Chevron, Walt Disney. I think you guys know most of these are names. These are household names, yeah, in the US. Johnson and Johnson, that's the vaccine. The most blue chip of all. Even you can see Coca-Cola, McDonald's, yeah. So this is what you do. You select some blue chip stocks. And talking about diversification, let's say you want to diversify and have the different sectors, or rather the different categories of stocks. So you pick some stocks in the growth sector, and then go back, pick some stocks in the blue chip, pick some blue chip stocks, and then even talking about diversification, you might also want to add some value stocks, right? So under this category, you'll find some value stocks like Berkshire Hathaway, you'd find Procter & Gamble, you'd find Nvidia, you'd find Walt Disney, you'd find AT&T. So these are some of the value stocks that you add to your portfolio, okay? At the same time, we also talked about an income portfolio. Let's say someone wants to generate consistent income. So it'd go for the dividend stocks. So click on dividend stocks. You'll go for companies like, let's say, the Ultra Group, Chevron Corporation, Realty Income. And then for Realty Income, this is a rate that offers monthly income. So you'd click on Realty Income and buy some shares of Realty Income. So this is for dividend portfolio. And I think when we talked about investment strategies, I told you guys, it doesn't matter if your approach is growth or value. You always want to have an income portfolio. That's dividend stocks. And why do you need to have dividend stocks in your portfolio? This is because, you see, right now I'm telling you, Meta has given investors a return of over 100% year to date, right? But this return is only achieved once you sell the investment, right? So you also need to have some stocks that give you monthly or even quarterly returns, right? So it's important. It doesn't matter if you're a growth investor or you're a value investor, always have some dividend stocks in your portfolio. Under categories, you can also see, for the guys who love Warren Buffett, you can also see some of Buffett's favorites. These are some of the stocks that Buffett has in his portfolio. Okay, let's look at some other categories. For the large cap stocks, these are guys who want some security. These are some of the largest companies in the US, the likes of Apple, Microsoft. Actually, Apple is the biggest company in the world. So Apple, Microsoft, Google, Amazon, Tesla, and Johnson & Johnson, right? So we have talked about the categories. Remember I mentioned about the sectors. I told you guys we have 11 sectors in the US. So it's important to understand how do these various sectors perform during various market conditions, okay? So let me just do a quick overview of the sectors. During high inflation, when you have high inflation, there are two sectors that perform well during high inflation. So we have the consumer defensive sector and we have the energy sector. Okay, and even the healthcare sector. So these are sectors that are considered sort of defensive sectors. The consumer, even from the name itself, the consumer defensive sector. The energy sector has performed well during high inflation, especially from 1973. Historically, the energy sector has performed well. And this was one of the reasons why the energy sector performed well last year. So you can just come to the sectors. I've told you guys about rebalancing. I've told you guys about diversification. So you also need to take into account the various sectors. So just come to the sectors. We have 11 sectors in the US market. Click on any sector. Let's say you want the energy sector. You'll be able to see some of the energy stocks that we have on our portfolio, right? On the other hand, you can click on let's say click on the technology sector. You can be able to see some of the technology stocks that we have on our portfolio, on our app. So it's important to always take into account the sectors when investing on basically managing your portfolio. So let's go back, right? We also talked about indexing. These are guys who are a beginner. Let's say you're a beginner and you've just opened the app and you want to start investing. Where do you even start, right? So we have Kenyan stocks, we have US stocks, we have US ETFs. Where do you start? So I told you guys, if you're a beginner, you start with indexing. You start with the index ETFs. So let's go through that. Just come to under US ETFs. When you click US ETFs, you'll be able to see all ETFs. You can see index ETFs. You can see dividend ETFs. You can see Bitcoin ETFs. You can see the fund ETFs. You can see the marijuana ETFs. You can see the oil ETFs. You can see the leverage ETFs. Skip all that. Come to index funds, right? When you click on the index fund, what's the first index fund you see? You see the SPY. So this is where you start as a beginner. Okay. So the SPY allows you to invest in the 500 largest companies in the US. And I think the reason why I've showed you guys, look at the chart. Basically, historically, this index has been going up since its invention. Okay, so that's the thing about indexing. With time, the easiest way to grow your money in the markets without a lot of trouble, especially for beginners, is to go for indexes. So this would be a good place to start. Another alternative for the indexes, you'd go for the VOO. You remember me mentioning the S&P 500 Vanguard ETF. Same thing. Let's look at the historical performance of the ETF itself. Let me see if I can get the chart. Same thing. So these are good illustration of how you can grow your money as a beginner without having a lot of trouble. Investing in index ETFs. Okay. On the other hand, I talked about investing in the Nasdaq 100. This is more volatile compared to the two. So how can you invest in the Nasdaq 100? You can invest in the Triple Q Trust Series, right? So this allows you to invest in mostly the tech sector without even having to select individual tech stocks. Let's look at an all-time performance, same thing. Okay, so that's why you're told to hold or rather invest for the long term. Okay, okay. So after that, let's look at some other alternatives. Let's say you've already done your index funds, you've already put some index funds in your portfolio. I think it's time now to search for individual stocks individual ETFs to invest in. So what's a good example of an ETF to invest in? I think, let's go for an ETF like the JP. So you just come here, type the ticker symbol of the ETF you want. So type JP. Bus. You have the ETF. So that's the JP Morgan Equity Premium Income ETF. And then you can just buy normally as you would buy stocks. So let me click on buy. So when you're buying, I think you can see, just click on market rate. You can use market rate, buy stock, buy limit, any that you want. Shares, when buying, you can buy as little as $5. And you see, the ETF itself, it's going for how much? How much is the ETF going for? 54 USD. But you don't have to spend 54 USD. You can just buy as low as 5 USD, and then you'll get 0.09 of that ETF. And that's what we call a fractional share, or rather a fractional part of the ETF. And then you can choose your wallet. Let's say you choose the USD wallet, and then buy. And this is the cost. You can see the order amount will be $5. The transaction charge, as I had mentioned in previous webinars, we charge 1% for both Kenyan and US stocks. So transaction charge will always be 1%. So what's 1%? That's 0.05 USD. So basically, you'll be spending 5.05 USD to make this investment. And then you're told the market is closed, but the market will open in the next 4 hours, right? So your trade will be executed once the market opens. I think this is a question that most guys ask. If I buy right now, will my order go through immediately? So the market, the US market specifically, currently is opening from 4:30 p.m. to 11 a.m. But you don't have to buy during market open. You can buy outside market hours. What will happen is that the order will be pending until the market opens, and then the order will be executed at market open. So don't worry, you don't have to wait for the market open to buy. Okay, you can buy anytime. The only thing that will happen is that the execution will take place after the market opens. So that's the thing about, let's say you've already chosen your index ETFs, and then you're going to the individual ETFs that you want. Let's say JP, we mentioned JP on the WhatsApp group a few days ago, because of its consistent returns, etc. So these are some of the things you can look at. So every time when I send an ETF for you guys to look at on the group, just come search for the ETF and look for the ETFs under the all ETFs segment. Okay, so we also show the ETFs using the various issuers. So the biggest issuer of ETFs is called BlackRock. It's also the biggest asset management company in the world. So you can also see all the ETFs issued by BlackRock. I think you guys can see the options that we have. So there's so many options. And one thing I always tell people is don't just remain in the stocks category. Go to the ETFs. Just do your research on these ETFs. The ETFs, just click on a random ETFs like the iShares Core US Aggregate Bond ETF, the AGG. Just do a simple search on Google. What's the investment approach of this ETF, the historical returns, the dividends, etc, etc. So these are some of the things you look at. So you'd search for the ETF by ticker symbol. You can also search for the ETFs using the various issuers. So we have ETFs from BlackRock, we have ETFs from State Street, we have ETFs from Vanguard, we have ETFs from Invesco, ETFs from ProShares, ETFs from Charles Schwab, ETFs from ARK. These ARK ETFs will be mostly for the guys who are more, these are more aggressive category of ETFs, the ARK ETFs by Cathy Wood. Let me click on ARK. So let's say you want to invest in innovation. Let's say the tech stocks, the aggressive, for an aggressive investor. You go for the ARK Innovation ETF. Let's say the ARK Next Generation Internet ETF, the ARK Autonomous Technology and Robotics ETF. Yeah, these are some things you'd look at, you'd go for when investing in, let's say, the tech sector. Let's look at performance in the 1 year, all time. Okay, 1 month, 3 months. So you can be able to look at the performance of these ETFs, right? So I think it's time to mention what's the theme for 2023. I think for 2023, guys are talking about artificial intelligence. So where do you start? I think this is a good place to start. So you'll go for, let's say you look at let's say the ARK-Q, the ARK Autonomous Technology and Robotics ETF. I think this ETF has a huge holdings in artificial intelligence. So these are some of the ETFs you look at to invest in artificial intelligence. This ARK ETFs, if you want to invest in artificial intelligence. On the other hand, the guys who ask, do ETFs pay dividends? Yes, they pay dividends. Just click on the dividend ETF, and you'll be able to see some of the dividend ETFs that are available. So click on the VIG, that's the dividend appreciation Vanguard ETF. Then we have the VYM, that's the high dividend yield ETF offered by Vanguard. You can also click on this SCHD. I really love this ETF personally. The US Dividend Equity ETF, SCHD. Okay. And you can also look at the profile. The investment seek to tackle as costly as possible the total returns of the Dow Jones US Dividend 100 Index. The fund invests at least 90% of its net assets in stocks that are included in the index. Okay, so the index is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. Then you can click on buy, and same process to buy. Okay. So that's on the dividend ETFs. Bitcoin, if you want to invest in Bitcoin ETFs, you can click on the Bitcoin ETFs. If you want to invest in marijuana ETFs, if you want to invest in oil ETFs, then click on oil ETFs. Yeah, you can invest in some of the oil ETFs available on the platforms. I think there's some rectifications that are needed there, but we'll work on that. You can also scroll down and see some of the most traded ETFs on Hisa. So let's see. So the S&P 500 ETF is the most traded on Hisa. So you can see some of the people who are investing in this ETF. Then the second one is the JP Morgan Equity ETF. This should be JP, I think. Yeah, this is JP. Then we have the US dividend equity ETFs. I think most investors on our platform want the security of the index ETF, that's the S&P 500, and some dividends from the JP Morgan equity ETF and the US dividend equity ETF. So these are some of the ETFs that are most traded on Hisa. So actually the first one has been traded by over 123 people in May 2023. It's quite amazing. In the past May, we've only been May in the past 4 days, yeah. So 123 people have invested in this ETF. So you might want to look at it. Why are people investing in that ETF? You can also see ETF by asset class. So I told you guys you need to do a balanced portfolio between bonds, let's say equity ETFs, real estate ETFs, preferred stock ETF, alternative ETFs, volatility. So you can just click on the asset classes and find various ETFs under that category. Okay. So that's on ETFs, US stocks. Finally, let's look at the Kenyan stocks. I think I focused a lot on the Kenyan market. So for the Kenyan stocks, the same thing. You can click on all stocks and search stocks with maybe the name. You can search, let's say Safaricom. Search for Safaricom. And then you'll be able to get Safaricom. Let's click on Safaricom. And then the buying process will be the same. So you can get details about Safaricom, and then you can see the marks, the performance of Safaricom, marks performance. And then you can, for the guys who like a more visual representation, you can go to the candlesticks. You can view the candlesticks, but you can also view the line graph. So let's select buy. So buy is the same. So for the Kenyan market, it's quite different because for the Kenyan market, unlike the US market, I told you guys for the US market, you only need 5 USD. For the Kenyan market, it's the criteria shifts now. You need to buy at least 100 shares. So for the US market, it's about the money, $5. But for the Kenyan market, it's about the amount of shares. So for the US market, the minimum is, for the Kenyan market, the minimum is 100 shares. So just select 100 shares of Safaricom. You can choose market rate and then the order type, buy stop or buy limit, and then select payment method is FIB wallet. Please know that to buy Kenyan stocks, you need to have money in your FIB wallet, not in the other wallets. And then the order amount will be 1,600, and then the transaction charge, as always, 1%. So you're spending 1,600. You're buying shares worth 1,600. The transaction charge is 16, and then the buy cost will be the total, which is 16. So it's telling you the market is open, but the market will be closing in the next around 1 hour 30 to 40 minutes, right? So the cost will be 16. So for the Kenyan market, same thing. So the Kenyan market opens from 9:31 a.m. Kenyan time and closes at 3 p.m. Kenyan time. So you can buy at any time, but the order will be executed when the market opens. So right now the market is open. The Kenyan market is opened, right? So let's go back to the various categories. Okay, so what are some of the categories available in the Kenyan market? You'd go for, let's say you just want to spend some little money. Let's say you only have like 300 bob or even 400 bob. You can look at the penny stocks. So penny stocks will basically be stocks that are going for less than, let's say, 100 Kenyan shillings, or these are stocks that are going for less than 1 Kenyan shilling or even 2 Kenyan shillings, right? So this would be the likes of Uchumi, Home Africa, Everready. So let's click on one stock. Let's click on East African Cables, or even let's click on a company like Uchumi. So Uchumi, click buy. So for you to buy 100 of shares of Uchumi, you'll spend 18 bob. You see, so you can invest a minimum, you can start with a minimum of 18 bob. The transaction charge will be 1%, so that's 0.18 Kenyan shillings, and then the buy cost would be 18.18. So you don't need a lot of money to get started. So you can start with little money, and the guys with little money, you'd go for the penny stocks. Okay, so we have some penny stocks like East African Cables, Transcentury, etc. On the other hand, let's talk about dividends, which the guys who ask in the Kenyan market, which companies should I invest in to get some good dividends? So you click here, dividend stocks, and you'll be able to see some of the companies that offer dividends in the Kenyan market. So you'll see the companies here. You can see a company like Umeme. Umeme has a dividend yield of around 15%, which is the highest in the market. That's Umeme. And then we have the likes of Stanchart, right? Stanchart, Umeme, same thing, dividend stocks. Okay, the guys who ask, what are some of the value stocks in the Kenyan market? Just click on categories, go to value. And then for value investors, these are some of the companies you'd go for. And then on the other hand, let's say you are a growth investors, which are companies that are considered growth stocks in the market. Just click on growth stocks and be able to see some growth stocks available in the market, right? So that's it on the categories. So let's go back. So I think you guys have seen basically how you'd select a mix of stocks from all the markets available, right? So I think, let me see if I can get a good representation, because this is like the dummy app. Let me see if I can get that. Let's see. Okay, so because this doesn't have any holdings, I want you guys to click on the blue part on your app, and then if you have any holdings, you'll be able to see like a circle, or rather a pie chart with the weight of various assets in your holdings. So you'll be able to see the bonds that you have. If you have in your holdings, you'll be able to see the equities, the stocks that you have in your holdings, the ETFs that you have in your holdings, etc, and the distribution between the various markets. So when you're managing your portfolio, you always need to go back to your goals and make sure that the weight of various elements between equities, bonds, etc still is the same as what you had intended when making the investment at first. So when going to portfolio management, when doing portfolio management on this app, that's the first place you need to click on. You'll click on the blue button, this one, and then I think I've said this is the dummy app, so you can't see in that format, but click on your app, click on portfolio, and just look at your assets. Look at how your assets have been performing. And I think another thing I forgot to mention when it comes to managing your portfolio is returns and the risk and the thing about loss. I think most the guys who have been in the market for quite some time, you've been told you don't need you should not be emotionally attached to a specific stock. So when you go to your stock and you see your stock is down like 70 or even 80%, I think it's time to sell that stock and accept the loss and look for other opportunities in the market. Look for other, live to fight another day. So that's the thing about portfolio management. I think for me, I always advise people to be active. I don't like the passive investment strategy. I think the best approach is to have a blend of both. Be passive, let's go for the US ETF, the index ETF, but at the same time, just be active. Always look at your portfolio, look at what needs to be done. So look at the shares that have, let's say, and now you bought when they were undervalued and now they're sort of overvalued. So you need to reduce your holdings in that. So you can see all that in your portfolio section. So just look at the returns. Let's say a company that has given you, let's say, like 100 or even 120%, year to date, I think that's a company you need to, let's say, reduce your holdings and look for other companies that are likely to give you the same returns in the few coming months. Okay. Another thing, as I mentioned, you also need, when you're looking at the market conditions, look at the holdings, the companies that you have. Ask yourself a simple question. In which sector are these companies located? I mean, these companies belong to which sectors? So you're like, okay, it's quite interesting that my portfolio has stock in only one sector, let's say the technology sector, or maybe you have holdings in the consumer cyclical sector. So you need to do something about such a portfolio. So you need to rebalance your portfolio, have some bonds in your portfolio, have some rates in your portfolio. So always look at your portfolio. I think that's a homework for you guys, and try to figure out what's your whole, if your portfolio is well diversified, and if your portfolio is adapted to the current market conditions. So I think that's it for me. I don't want to talk a lot because I think the webinar is supposed to end at 1:30, but anyway. So let me get some questions and then we can call it a day. And then I think I forgot to mention, under rates, we don't have a specific category for rates. So you just, when searching for rates, you just search under US stocks. You don't just search under US stocks. So click on US stocks. And then you can search, let's say, the realty income. And then you can see realty. Let me see if I can get realty. Okay, you can also see some, let me see if I can, let me use the ticker symbol. Oh. Okay, Sasa, no problem. Anyway, therefore, just what I was as I was saying, you can search for the rates under all stocks. Search for any rate that you want, and you'll be able to find it under all the stocks, all the US stocks. But for the ETFs, you go to the US ETFs category. So we have not yet separated the stocks and the rates. So you can find stocks on the stocks category, ETFs on the ETFs category. And then the CDSC button is basically for guys who want to invest in Kenyan stocks and maybe don't have an account, they want to connect their CDS account with our app. So that's when you click on CDSC. So let me see your question, guys. So Ronald is asking, how do you analyze the risk that you're taking in your portfolio? Okay, that's a good question. So there's a complex way to analyze it, and there's a simple way to analyze it. So the simple way to analyze it is basically looking at the sectors and basically the various elements of the company. Okay, which are some of these elements? There are some sectors that are more volatile compared to others. Okay, so someone who is investing in the tech sector is more exposed to risk than someone who is investing in the utilities sector. Okay, on the other hand, someone who is investing in large cap stocks, let's say you're investing in Apple. Apple is one of the biggest companies in the world. So it takes a lot of time for such a company to fall compared to someone who is investing in penny stocks. Penny stocks, these are companies that are going for below $5. So penny stocks these are not stable companies. These are companies that are just starting out, and they might not be as stable as compared to companies with huge cash flows. Yeah, so that's the thing about risk. Risk is determined by such factors such as the sector. Which sector are you exposed to? There are sectors that are more risky compared to other sectors. There are sectors that are more volatile compared to other sectors, right? And then on the individual stock, the various aspects of the individual stocks. Tech stocks will tend to be volatile all the time. When you're investing in the tech sector, just know that you should be ready for a lot of risk. But at the same time, you should also be ready for a lot of returns. That's for tech stocks, right? That's the element of risk. When you look at the complex element of risk, that's where we'll talk about, there's a measurement, this is how you measure how volatile a stock is using the beta calculation. I think I talked about that during our previous webinar about how to look at the beta of company, the alpha and the beta. So beta, alpha is used to measure the performance, how a company is performing relative to the benchmark index. And then for the when you look at the volatility, when you look at the beta coefficient of a stock, the beta will tell you, is this stock more, basically, is the company moving, or rather, is the company moving at a higher rate than the average of the market, or at a lower rate than the average of the market? So you'll find that volatile stocks will tend to have a high beta coefficient. So that's the complex way to look at risk, the volatility. So you can just research on how to use beta coefficient, beta or beta, how you want to call it, BETA, how to use beta to determine the volatility of a stock. And yeah, on the other hand, you can just do it simply, look at the sectors and how volatile the sectors are. Okay, so someone is asking, kindly add me to the WhatsApp group. Let me send the link and then you guys can join. Sasa, let me send the link. In the meantime, just send your questions on the group. Let me see. So Jeffrey, I've sent the link. Please make sure, if you're not on our WhatsApp group, please make sure you join, because I usually send a lot of resources on that group. Yeah. So let me send the link. Everyone. Hi. Done. Click on that link. I think everyone can now see the link. Confirm if you can see the link. Please raise your hand if you can see the link on the chat section to join our WhatsApp group. Anyone else? Confirm. Sir. Hi, that's it for today. Have an amazing time. I'll send the PDF that I've used to our WhatsApp group and you guys can go through it anytime you want. So I'll send a PDF. Have an amazing day. And remember, next week we have another webinar. And next week the topic is US stocks. Basically, we go deep into the US stocks, how to invest in US stocks. And then the week after that, we'll talk about US ETFs. So please make sure you don't miss. So we have finished the series on portfolio management, investing, everything. Now let's dive deep into the specific stocks. So next week, same place, same time. Sawa. Okay, final question. What percentage levels for different sectors would you recommend in a portfolio? So it depends with your strategy. So if you're a more conservative investor, you want to have, let's say, more holdings in this specific sector. Let's say have like 40 in utilities, have like, let's say 30 or even 20 in healthcare, have 30 in healthcare. You can go for healthcare or you can go for the consumer defensive, and then just have a simple 10 or 20% in growth sectors such as the information technology or the consumer cyclical. So basically it's not about the specific percentages, but the amount. So have more weight in the more conservative sectors and have very little weight in the more aggressive sector. That's for an conservative investor. On the other hand, for a growth investor, an aggressive investor, I think this is an investor who would have, let's say, have like 40% or even 40%, let's say 40% holdings in sectors such as the information technology sector, and then you also want to have some penny stocks in your holdings. And then for the indexes, you'd want to have the, let's say, the ARK ETFs, that's the tech ETFs. At the same time, you'd also want to have very little holdings in the, let's say, the utilities, in sectors such as utilities and consumer defensive, right? So just do your research on, just do a simple research on the 11 sectors in the US market, and just look at the individual sectors. How do these sectors perform, and which sector is good for which kind of portfolio? I think with that information, just knowing that the sectors and these sectors perform differently, I think from there you guys can be able to have a place to start. So the sectors, and also look at the various asset categories. Another thing you might want to note is that stocks and bonds historically have moved in opposite directions, right? So when stocks are up, bonds tend to be down, and when bonds are down, stocks tend to be up. So that's another thing to consider when coming up with your portfolio. So you need both in your holding, so that at any point in time, you're not down, like down. So always have a balanced portfolio between both assets. The recommended portfolio, rather a typical portfolio, is usually the 60-40 portfolio. A 60 in equities, that's stocks, and then a 40 in bonds. So have an amazing time. For the guys who will be able to attend our IG live today, we'll have an IG live from 7 to 8. So you can follow us on all our social platforms, at Twitter and IG, I think, and also TikTok for the younger guys. So have an amazing time. Yeah, and remember to invest. That's it from me.